Hi, welcome back. Today we're going to cover Chapter 18, where we talk about how to move from reported taxes on the income statement to a measure that we use in our discounted cash flow analysis called operating cash taxes. And this is a really important and a very technical piece of the analysis, and we're just going to do a short overview of the most common issues, but in some cases we could find our analysis of the firm's tax structure to be one of the most complex things that we analyze. And particularly if we're looking at a firm that has a famously complex tax structure, for instance, analysts of GE or Amazon or any of the big tech firms right now, honestly, would all spend quite a bit more time trying to understand the tax rates. And it's for some of the reasons that we've already talked about. For instance, a firm that does business in another country, and we'll see this in the examples that we're going to look at, is going to face different tax rates. And in firms that have really complicated tax structures, they do business in dozens of different countries, and perhaps they use sort of multinational tax avoidance strategies. Calculating the taxes that the firm actually pays is not a simple procedure. This isn't a tax class. We're not going to go into all that. But you should be aware that this is just an overview here, and that the actual process could be much more complicated than what we're going to do. So the issue that we're trying to adjust for is that reported taxes, those are the taxes that show up on the income statement on the firm's 10K, are going to combine operating, non-operating, and financing items. In other words, if we think about the income statement, taxes are down at the bottom, so there's going to be operating items in there like EBITDA, and then there's going to be non-operating items like amortization, and then there's going to be financing items like interest, all being removed or being accounted for before we take out taxes, before we pay taxes. And so what we want to do is calculate the tax rate, remember, just on the operating items. Right? Remember, NOPLAT is purely an operating cash flow measure, and so that means that we want to calculate taxes when we're calculating NOPLAT just on the operating cash flows. And so we need to calculate an operating tax rate. So that's what we're going to do first. We're going to talk about ways to estimate operating taxes, just the operating tax rate, using company disclosures. We're going to talk about the levels of information that we have and how we can use different levels of information to calculate the tax rate, depending on what we have. And then we'll talk about how to move one step further, which is to move from accrual-based taxes to what we call a cash tax rate. So we're going to look at deferred tax assets and liabilities, and how we adjust for those when we calculate the operating cash tax rate, which is the final tax rate that we'll use when we're doing NOPLAT. Right, so let's start by looking at firms with full information. Let's look at the firm's financial statements and see if we can calculate the operating tax rate versus the reported tax rate. So here's an income statement broken down by geography and by subsidiary for an example firm. So this is a firm that just has a domestic subsidiary, so they've got one subsidiary that operates in the US and a foreign subsidiary that operates in some foreign country. They're going to have disparate tax rates. They're going to earn income in the domestic subsidiary that's separate from the foreign subsidiary, and again, they'll have operations that are separate in each different location. So if we're inside the firm, or if we're a consultant working for the firm, we would have this level of information. Right? We would have these first two columns, the subsidiary breakdown of income. If we're outside the firm, all we would have is this far right column that says consolidated. This is the consolidated income statement. This is what would be reported on the 10K. And so you can see that the consolidated income statement is simply the sum of the row for each item on the separated income statements. The problem being is that we don't know in the consolidated income statement, we don't know the split. So I don't know how much income was earned in the domestic versus the foreign subsidiary. And that's really important if I'm trying to figure out what the firm's overall tax rate is. So let's look at this firm. They got domestic subsidiary, they got $2 billion in revenue. In the foreign subsidiary, they got about $500 million. They have amortization in the domestic subsidiary only. That means the domestic subsidiary is the one that owns the intangible assets. So they're amortizing the intangible assets inside the domestic subsidiary, but they don't have any in the foreign subsidiary, so there's no amortization there. So then we can look at EBIT there. EBIT in the domestic subsidiary is 1.6 billion. Foreign subsidiary, it's not adjusted for amortization, so EBITDA and EBIT are the same. Then we've got interest expense in the domestic subsidiary, 600 million. Again, it looks like this firm only has loans, they only have debt held in the domestic subsidiary's names, and the foreign subsidiary does not have any debt. So only the domestic subsidiary is paying interest, right? And we'll talk about why that is. And then we've got gains on asset sales. And we see that that's only in the foreign subsidiary. The foreign subsidiary sold some assets. They sold it for more than book value, so they've got a gain on the asset sale there. And the domestic subsidiary doesn't have any entries there. So then we have EBT, earnings before taxes, of $1 billion and 550 million in the foreign subsidiary. Then we pay taxes at the statutory tax rate. So in the domestic subsidiary, the statutory rate in the US is 35%, so we pay 350 million in taxes on $1 billion in earnings for net income of 650 million. In the foreign subsidiary, the foreign tax rate is 20%, so we pay 20% on 550 million earnings, or 110 million in taxes, 440 million in total net income there. And so we can see additionally that the firm has some R&D tax credits, and they have a one-time tax credit. So R&D tax credits, we talked about this a little bit, I'll talk about it again in the example. R&D tax credits are tax credits provided by usually local governments to big firms to encourage them to locate their research and development activities inside the city or the municipality or whatever. And cities really like this kind of tax credit because their intuition is that if a firm locates their research and development activities in that city, they will locate some of their highest paid employees who will then buy houses and pay property taxes and pay school taxes and pay income taxes. And since they're all highly paid, they'll pay lots of taxes. So the firm gets a break in order to locate its employees there, who then are going to support the tax base for the city. So these are usually ongoing. They're typically scaled with company size. So we expect things like R&D tax credits to scale with the company and to continue to be part of operating. And we would think about this kind of tax credit as an operating measure, because this is why the firm has located its operations in that city. And if they moved it somewhere else, they wouldn't get these R&D tax credits. Now, one-time tax credits, this here particularly for this firm, this was an audit revision. They had auditing team come in. They looked at the last couple of years of tax statements. They realized that they had overpaid on taxes in a previous year. They filed a revision with the US government. They got a $25 million credit saying, we agree, you paid too much in taxes. Here's a credit. It will reduce your taxes owed in a following year. And that's what's happened here. They're getting their taxes reduced via this credit from a previous year. Right? So we can see the taxes that are actually paid here. If we look at the first two columns, 350 million plus 110 million, and then we reduce those taxes by the value of the tax credits, 40 plus 25 million. And for our reported taxes, that's what's over there in that far right consolidated column of 395 million. So these are what we call reported taxes. You can see the statutory rates down at the bottom, and you can see the effective rate. And notice that the effective rate is in between the statutory rates, because we're paying 20% on some of our income, 35% on some of our income, and we have these we have $65 million in tax credits. Our effective rate is going to be considerably less than the domestic rate, still a little bit higher than the foreign rate, and falling somewhere in the middle. That's the effective rate, is the rate of taxes that we actually end up paying after all our tax credits. So this is full information. Again, we would only have this level of information if we were inside the firm. Okay. And I want to go back and point out, I told you I'd tell you why we have, think about why we have amortization and interest only in the domestic subsidiary, right? Notice that these two things are both reducing my EBT, my earnings before taxes, which effectively is reducing my total taxes paid. Now, if you're working at a firm like this and you have the option to do so, you would want to structure your accounting statements and structure your holdings so that you reduce your taxes as much as you can, right? It's not illegal, it's good accounting. So what we do here is we recognize that that having debt and paying interest and having intangible assets that I amortize both reduce my taxes. And so I would want to hold those in the subsidiary with the most to gain from reducing taxes. In other words, you will very often see that all of the firm's debt and anything that can be tax reducing, like intangible assets that are amortized, are going to be in the subsidiary with the highest statutory tax rate. Because why would I pay $600 million in interest in my foreign rate when that's only going to reduce my 20% taxes? I'd rather pay it in my domestic rate where it's reducing taxes at a 35% rate. So that's why we see these totally localized to the domestic subsidiary. And again, there's many tax strategies that take advantage of this fact, where a great deal of debt is taken on in a domestic subsidiary and used to reduce taxes relative to the foreign earnings. Okay. So we talked about the tax credits here, so I won't go. Now, how do we think about what's called the operating tax rate when we have full disclosure like this? Okay, so we have all the information. And the answer is, it's very simple if we have all the information. If we're inside the firm, there's not much to do to calculate the operating tax rate. So how do we take full disclosure information and calculate what's called the operating tax rate? Now, the operating tax rate is computed as if the company is financed entirely with equity, meaning we ignore any financing costs associated with debt. So we want to calculate the taxes that would be paid if we didn't have an interest tax shield. So that means we need to be above EBIT, or we need to be EBIT or above, calculating taxes based on EBIT or above, so that we ignore the interest tax shield. We also want to calculate just operating taxes, which means we need to be above any non-operating tax shields like amortization, right? Which means we need to be at EBITDA. And that's what we're talking about. We want to calculate the tax rate based on operating profit, which is EBITDA, and we would calculate the taxes as if they were paid just on operating measures. And that doesn't mean that we're going to ignore the value of the interest tax shield and amortization tax shield. We're just going to consider it separately in a different way. Right? So we're not going to consider it when we calculate NOPLAT. Again, NOPLAT's just operating profit less adjusted taxes. This is the adjusted part. But we'll account for the value of the interest tax shield and things like that when at a separate point when we do the weighted average cost of capital. Okay. So in this case, if we have full information and we know the statutory tax rates for both our subsidiaries, it's actually really, really easy. Just go up to EBITDA, multiply EBITDA times the statutory tax rate in the US, 35%. So we get $700 million in operating taxes on $2 billion in EBITDA. The foreign subsidiary has $500 million. We pay a 20% statutory tax rate on that income for $100 million in operating taxes. We include the R&D tax credit here. This is related to the operations of the firm. It's going to grow with revenue. So as we get the tax credit is a percentage-based tax credit, so as we earn more income, we'll get higher tax credits. Higher revenue, we'll get higher tax credits. So that's going to be included in operating taxes. So 700 in the operating taxes of 700 million, 100 million minus 40 million tax credit gives me consolidated operating taxes of 760 million, and that gives me an operating tax rate of 30.4%.